A very good morning to all of you students. We will again continue on the topic of derivatives today. Students, in our last session, we have gone through the concepts of binomial model and the valuation under binomial model. So today we will be taking some of more questions on binomial model, and then we will go to Black-Scholes model. Okay. So let's start with question number 3, students. Question number 3 is actually a question on commodity derivatives. Commodity derivatives is part of our syllabus. So let's go ahead. A call option on gold with exercise price of rupees 26,000 per 10 gram and 3 months to expire is being traded at a premium of 101 per 10 gram. It is expected that in 3 months time, the spot price might change to 27,300 or 24,700 per 10 gram. At present, this option is at the money and the rate of interest with simple compounding is 12% per annum. Is the current premium for the option justified? Evaluate the option and comments. So students, this is a very simple question on binomial model wherein we need to find out the probabilities first, then the value of this option, and then accordingly comment whether that value of option is okay to be taken as 1010 per 10 gram, which is being traded in the market. Okay, students. So let's start. Calculation of probabilities. So the probability of price going up. Okay. Let's assume probability of price going up. BPU. Good morning, Shailesh, Viraj, Tanisha. Good morning, everyone. So PU is equal to 1 plus R minus D divided by U minus D. Correct, students? So in this case, 1 plus 12% for 3 months, 12% for 3 months, yes, minus D is the ratio of lower divided by current price, 24,700 divided by 26,000, whole divided by U is the upper proportion, so which is 27,300. 27,300 divided by 26,000 minus 24,700 24,700 divided by 26,000. So if we solve this, the probability of price going up comes out to be 0.80. If the probability of price going up is 0.80, the probability of price going down will become 0.20. Okay. Hence, value of option can be calculated as follows. Okay, so event price going up, price going down. Strike price is 26,000, correct? What is the strike price? 26,000. Then what is the expected price? In case the price goes up, 27,300. In case the price goes down, 24,700. So the payoffs will be 1,300 and 0. Correct? Then weighted payoffs. So what is the weight? 0.80 into 1,300. Correct? Which is the probability itself. And 0.20 into 0, which is equal to 0. So this is how much? zero point 0.8 into 1,300 comes as 1040. So the total weighted payoffs is 1040. So the expected value of option at 3 months end is equal to this much. So the value of call option as on today will be 1040 divided by 1.03, which is the present value of this, correct? Which comes as 1009.7 or say 1010. Okay. So now students, since we have got the answer, can we compare this with what it is currently being traded at? Yes. So in the question also, it is said that it is trading at 1010. So can we say that the option price is justified? Yes, because the calculation also is coming at 1010. So we can say that thus the price of option is justified. Okay, students? Clear? Easy and clear, students. I hope. Yes, Tanisha, your answer is correct. 1040. Let's move ahead. Let's come to question number 4. Question number 4 says that a call and a put exist on the same stock, each of which is exercisable at rupees 60. So both of them have a strike price of 60. They now trade for the market price of stock or stock index is 55, which is the spot price. Market price of call is 9 and put is 1. Okay. Calculate the expiration date. See, students, this is what they're asking. Expiration date, cash flow, investment value, and net profit from buy one call, write one call, buy one put, write one put. So they have given us all the 4 scenarios, 2 for call, 2 for put. For expiration date, stock prices of, if let's say they are saying if actually the price comes out to be 50, 55, 60, 65, and 70, then in all these scenarios, calculate for these 4 options the expiration date, cash flows, investment value, and net profit. So student, this is very easy actually. So let's go to first of all expiration date, cash flows. Okay. So let's take stock positions here. Buy one call or write one call. Second option is write one call. Then buy one put, write one put. And the price here is 50. Then it is moved to 55. Then next is 60, then 65, then 70. So students, Tell me one thing. If I have bought a put, if I bought a call option, I have a right to purchase. If I have a right to purchase, will I exercise in case the price has gone to 50? No. The strike price, students, please remember, is 60. Okay. That is given in the question. So in case of 55, will I ever exercise? No. In case of 60, will I exercise? It can be yes or no, but I will become neutral because 60 is at the money. 65 is where I will exercise the option. And while I exercise the option, I will end up paying 60 rupees. Correct? As outflow for purchasing the share. In case it goes to 70, then also I will end up paying minus 60. If I write one call option, if I write one call option, there is nothing since the call option will not be exercised on 50, 55, and 60, there will be no cash flows. However, on 65, I will get a positive cash flow of 60 because the call option holder will exercise the option. And here also I will get 60 rupees. Now, in case of buying one put, I have a right to sell. I will exercise that option once the price actually goes below 60. And in first case itself, the price is below 60. So what I will exercise? Yes, I will exercise the put option. So the positive cash flow to me, if I have bought one put option, will be 60 rupees. Here also 60, here nil, nil, and nil. Okay. Then if I have written one put, that means I have sold the right to sell. If I've sold the right to sell, that means I will have to purchase if the option gets exercised. Here the option is getting exercised. Viraj, right is basically the selling. Viraj, you can refer to my previous sessions. I have clearly explained who is a writer, when we call it as a right, who is a buyer, who is a holder. Okay, Viraj? Yes, number right is out of the money. Yes. Okay. So the expiration date cash flows is clear. Then let's come to expiration date investment value. So the expiration date investment value. By investment value, they mean the value of the option. Okay, whatever is the payoff of the option. Again, 50, 55, 60, 65, and 70. First one is buy one call option. Write one call option. Then buy one put option and write one put option. Okay. So call option, will it get exercised here? No, right? So again, the value will be 0. However, the investment value, that means the option value will become 5 rupees here and 10 rupees here. Similarly, this, however, for the option writer for call option, there will be a -5 and -10. Reason being, they will end up paying 5 rupees and they will end up paying 10 rupees in case of 65 and 70. Okay. Now, in case of buying one put option, if someone has to buy one put option, then 60 is the strike price. In case of 50, 10 rupees will be a benefit. Similarly, in case of 55, 5 rupees will be a benefit. Okay. Writing one put option, 10 rupees will be a loss. And similarly, 5 rupees will be a loss. Then rest all places, it will be 0. Okay. Then last, expiration date, net profits. So net profit, students, how we will compute? Payoffs at the end minus premium. sorry, minus premium paid or received. Okay. Again, let's take these examples 50, 55, 60, 65. Sorry, and then 70. Buy one call, write one call, sorry, buy one put, and then write one put. Okay, students? So, in case of buying one call at the rate of 50 rupees, the call buyer would have paid a premium, students, correct? What is the premium amount? 9 rupees, students, is the premium for call, and 1 rupees is the premium for put. So at the first place, the call option holder would have paid 9 rupees. And will he get anything on 50 rupees? No, right? Because the option is out of the money. Similarly, at 55 also, it will be minus 9. At 60 again, it will be minus 9. However, at 65, 5 rupees is what this person is getting. So minus 9 plus 5. So that means minus 4. Correct? This is the net loss. And in case of 70, plus 1, which is 10 minus 9, students. Okay. I hope this is clear, students. Good morning, Shruti. Then writing one call option. Writing one call option mean there will be a income. Correct? Till here. Now at the rate of 65, I have written one call option. I have received 9 rupees, but I have to pay how much? I have to pay 5 rupees. So net, my gain is 4 rupees. Similarly, at 70 rupees, I have received 9, I have paid 10. So net, there is a loss of 1 rupee. Okay, students? Now next, buy one put. So if I have bought a put option, 10 rupees is what I will get at the rate of 50 if I've bought a put option. But 1 rupees I have paid as premium. So 9 rupees is what my positive gain will be. At the rate of 55, 1 rupee is the premium I have paid. 5 rupees is the amount I have got. So plus 4 rupees. Similarly, at 60 rupees, I will not be exercising that option because it is a same strike price put option. I have lost 1 rupee on premium. Similarly, here also I have lost 1 rupee on premium. Okay, students. Then writing one put option. Again, I have to pay 10 rupees. I have received 1 rupee. So that means I am at minus 9. I have paid 5 rupees. I have received 1 rupee minus 4. Rest all places plus 1. Okay, students. I hope this is clear, students. Then we have done the question part. Okay. Now let's move to question number 5, students. So Ram holding shares of Reliance Industries Limited, which is currently selling at 1000. He's expecting that this price will further fall down due to lower than expected levels of profit to be announced after 1 month. Okay, wait. Tanisha is saying buy one put, write one put. Okay, buy one put. Let's start, students. Buy one put. In case of a put option at 50 rupees, the person who has bought that put will get 10 rupees, correct? Because 60 rupees is the strike price. However, the premium paid is only 1 rupee. See, students, the premium of put option is 1 rupee. Okay. So let's say I have purchased the put option. I will get 10. I have paid 1. So that means plus 9 I have got. At the rate of 55, I will get 5 rupees because 60 is the strike price. We're talking about put option. Put option, if the price goes down, the holder of the put option gets a benefit. So 5 rupees I will get a benefit. 1 rupees I have paid as a premium. So plus 4 is what my benefit will be. The net gain. At the rate of 60, there is no benefit to me because the strike price is equal to the spot price. Hence, whatever I've paid as a premium becomes my loss. Similarly, at 65 and 70 also. Okay. However, if I've written one put option, in case I've written one put option, I will receive 1 rupees as premium, but I have to pay 10 rupees as the difference in case the price is 50 rupees. So my net loss becomes minus 9. Similarly, minus 4, 1 and 1 here. Okay. Let's come back, students. So we discussed that Ram is holding shares of Reliance Industries, which is selling at 1000, but it is expected that it will go down because the level of profits to be announced will be lower. As on the following option contract are available in Reliance shares. These are the options available. These are the call and these are the put shares with the premiums also that are given. Perfect. Ram is interested in selling his stock as he cannot afford to lose more than 5% of its value. So it is a very logical question, students. See, first of all, yes. So first of all, the value that Ram can go up to maximum is 5% of its value. And Ram is already holding these shares. So if Ram is already holding these shares, that means Ram is exposed to downside risk. Correct. If he's already exposed to downside risks, then he should actually do what? I will come to that. Okay. First of all, let's read the question. Recommend a hedging strategy with option and show how its position will be protected. Yes, students, tell me. Ram is already holding these shares. So there is a downside risk. Correct. There is a downside risk. How will Ram protect his position? By purchasing a call option or by purchasing a put option. Tell me, students, what should Ram do? Whether option 1 or option 2? Tell me. So option 2 is purchasing a put option. Option 1 is purchasing a call option, students. Okay, Namrata and Mansha has given their answers, have given their answers. I request everyone to please attempt this. I have holding some shares and I have to do protect myself from the downside risk, because if I'm holding the shares, the prices goes up, there is no risk. If the prices goes down, there is a risk. So I have to devise a strategy where the prices goes down and I gain. When it will happen that the prices will go down and I will be able to gain? Come on, students, tell me. When it will happen if the prices goes down and I will be able to gain? It happens once I do the put option, student, which is the second option here. Please recheck, students. So I will be protected against the downside risk if I purchase the put option, because tomorrow if the prices goes down and if I've purchased a put option, I will gain from that put option. Okay. So we can say that instead of selling the stock of Reliance Limited, Ram must cover his risk by buying a put option. Now the question comes that which put option Ram should buy. Ram's maximum level is 5% of its value. So we can write that since Ram's risk appetite is 5%, the most suitable strike price in put option will be 950, correct? Which is 1000 minus 5% of 1000 rupees. Hence, Ram should buy a put option with strike price of rupees 950. Okay. Yes, Shruti and Tanisha. Perfect. So 950 Ram can buy, and accordingly he can prevent himself from the any downward prices. Simple. Okay. Let us move ahead, students. Next question. Question number 6. Let's move ahead, students. Okay. The market received a rumor about ABC Corporation's tie-up with a multinational company. This has induced the market price to move up. If the rumor is false, the ABC Corporation stock price will probably fall dramatically. So they have given us an event. If that event happens, the price will increase. If the event is false, then it will decrease. To protect from this, an investor has bought the call and put options both. Because in the event the price is going to go up, call option will help in benefit. In the event price is going to go down, put option is going to give the benefit. He purchased one 3-month call with a striking price of 42 for 2 rupees premium and paid 1 rupee per share premium for a 3 months put option with a striking price of 40. Determine the investor's position if the tie-up offer bids the price of ABC Corporation stock to 43 in 3 months. Now they're saying that let's say the tie-up has happened and it becomes 43 in 3 months. So students, first of all, this is a simple question, students. Okay. So first of all, we will calculate the cost of call and put options. So the call option is how much? 2 rupees per share, 2 rupees per option, and the lot size is actually 100. Okay. Similarly, here it is 1 rupee per share. Just a second, students. I think that information is missing here. Okay, let's do one thing then. Let's not take any lot size. Let's take it simply that 2 rupees is the premium for call option. Okay. And 1 rupee is the premium for put option. So this brings us 3 rupees for both call and put. Okay. Now, if the price increases to rupees 43 per share, in this particular case, students, what will happen? Call option, there will be a gain, right? Because 42 was the striking price. So 43 minus 42, 1 rupee, there will be a gain. However, there is a cost of both call and put that we have calculated above minus 3. So net there will be a loss of 2. Net loss will be minus 2. Then second, if let's say the price falls and the price of the stock falls to 36 in 3 months. So let's say the price decreases to rupees 36 per share. So put option was entered at a strike price of what? 40 minus 36, right? The price has gone below strike price. So put option will give us a benefit of 4 rupees. Will call option give us any benefit? Okay, let's see what is the strike price 42. What is the current price 36? No, there will not be any benefit on call option. Okay, and hence the cost of call and put together is minus 3. So there will be a gain. Net gain will be plus 1, students. Okay, students. I hope this is also very simple and easy. Okay, any queries till now, students? Any other question till now that is there in your mind? Please do ask me. Otherwise, we will move ahead. Now, I think we have done till 11th question. Let's come to 12th question. Okay. I think there is one more question on this binomial model. Then we will start our Black-Scholes model. Okay. Question number 12, students. A 2-year tree for a share of stock in ABC Limited is as follows. The starting is at 100, then N2 and N3 108.95, and then later on the prices are given. Consider a 2 years American call option on the stock of ABC Limited with a strike price of 98. So student, first of all, you're talking about a call option, strike price of 98. The current price of the stock is 100, which is what is given in N1 also. The risk-free rate is 5% per annum with a continuous compounding. They have given us the annual continuous compounded rate of 5% and the respective E power as well. Assume 2 time periods of 1 year each. Using the binomial model, calculate the probability of prices moving up and down. That we will do. Expected payoffs at each node N1, N2, N3, and we have to round it up to 2 decimal points. Okay. So this is easy and clear, students. Sorry. So first of all, we have to calculate the probability, right? Of probability. So PU, which is the prices, the probability of prices moving up, is actually given by R minus D divided by U minus D, correct? Which we know that e raised to the power 0.05 minus what is the downward price? 95 divided by 100, correct? What is the upward price? 108 divided by 100 minus 95 divided by 100. So probability of prices going up. So e raised to the power 0.05 is actually given by 1.05127. 1.05127 minus 95 divided by 100. 0.95 divided by 1.08 minus 0.95, which is actually equal to 77.9 percentage. Or let's say we are saying it is a 78 percentage. So the probability of prices going down will become 100% minus 78%, which is equal to 22%. Okay, students, till now we are clear. I hope this is clear, students. Okay. So 78% is the probability that the prices are going to go up, and 22% is the probability that the prices will go down. Then the next step is the expected payoffs. So students, first of all, we will have to calculate the expected payoffs from the 2 years later point of view, then take a present value of it, right? So calculation of expected payoffs. So first of all, add node N2. N2, yes. So for node N2, there are two possibilities, right? Either 116.64. After node 2 goes into the second year, it is 116.64 or 102.60. So 116.64 minus what is the strike price? Strike price was how much, students? 98. What is the probability? 78%. Plus 102.6 minus 98 into 0.22 or 22%. This whole divided by the present value, right? Which is 1.05127. The e raised to the power 0.05, right, students? Which is equal to this. So N2 becomes 14.79. Now N3, students, will be, one is 102.60 minus 98 into 22 percentage plus, sorry, into 78 percentage, sorry, students. Because in this case, now this is the probability of the price going up, right, students? 78% plus for the 90.25. For this 90.25, there will not be any payoff, right? Because it is below 98. 0 into 22%. Whole divided by again 1.05127. So the payoffs at N3 will become 3.41. Clear, students, till now? I hope this is easy and clear. Then finally, N1 will be weighted probability of N2 and N3 divided by the present value factor. 14.79 into 78% plus 3.41 into 22% whole divided by 1.05127, which is actually equal to 11.69. So N1 node's value is equal to 11.69 rupees. N3 is this much and N2 is this much. Okay, students, I hope this is easy and simple. Nothing to be worried till now. Okay. Then students, we will move to the Black-Scholes model. Students, all of you, please focus here. We will cover up the concept first, then we will go to the question. Okay. This is the most important part, right? And if you are able to understand, then it is very easy and very simple. Okay. It is not at all difficult, students. It is just a very simple formula based technique used to calculate the value of a call option or value of a put option. Okay. So students, please hear me out from there till the time I tell you, okay, very carefully. Then you will be able to understand it better. Yes, students, all of your attention, please hear. Now let's come to the Black Scholes model. We also call it as BSM, which is Black Scholes model. Short form is BSM. So students, you will recall yesterday I have given you 4 cases while explaining you the concept of options. So from that, I am taking case 2. I am taking case 2 to help you explain the Black-Scholes model. What was the case 2? Case 2 was I am purchasing the shares and what I am doing simultaneously, I am selling the call option, which is I am selling the right to buy. Selling the right to buy. You remember, students, I said that selling the right to buy, which is selling the call option, if I do that, then if this option gets exercised at the end, I have to purchase the share because I have written that call option, correct? I have sold that call option. It essentially means that I have to purchase the shares now so that if the other person exercises his right to buy, I will be able to give him the shares. So I have to purchase the shares today. Okay. So let's assume that this is done by Mr. X. Mr. X, he purchases the shares and simultaneously he also sells the right to buy. Okay, that means he writes a call option. Then, if I purchase the shares today, first of all, students, it will involve cash outflow today, correct? It will involve cash outflow today. And if I'm selling the right to buy, tomorrow, if that person buys, tomorrow, if this option gets exercised, then I will get the strike price equivalent amount, correct? Because I will have to sell the share to that person. So that cash inflow will be strike price, correct? This is on the option once it is gets exercised, correct? Now assume that you are Mr. X. You are in the position of Mr. X. You have done these 2 steps. You have purchased the shares and you have written a call option. And you are still deciding what should I put as a premium. So what you will do, you will say that, okay, I have done a cash outflow today of 100 rupees. I am expected to get a strike price of, let's say, 90 rupees as my cash inflow. As of now, please ignore the time value. Okay. Because this purchasing is happening today. Maybe this happens after 3 months. But I'm saying to keep it simple, as of now, ignore that. So the cash outflow today I have done to purchase a share is 100. And I have a written call option on that. If the call option gets exercised, my expected strike price I will get is 90 rupees. So don't you think the 10 rupees that I'm losing here, I should charge as a premium? Correct? My premium would be equal to the expected loss that I will incur on this call option. By purchasing the share today and writing in call option, whatever is the expected loss, I will expect that as a premium. So it gives me that, sorry, if this is A and this step is B, sorry, then A minus B becomes my premium of call option. Sorry, students. I hope this is clear. Now let us introduce. So we will use this basic formula, okay, and we will arrive at the Black-Scholes model. Okay, students. Yes, students. So A minus B is equal to the premium of call option. Now, there is a time difference between when A and B is happening. A is happening on 0th day, B is happening on, let's say, 3 months. We are talking as a time of 3 months for this call option to expire. Okay. So this cash outflow is happening today, and the 3 months later, cash inflow for strike price will happen. Now, since these two values are not comparable, can I modify the formula as A minus present value of B is equal to premium of call option? I think all of you will agree with me. Yes, I can modify this because the timing of A and B happening is different. Now, let us evaluate it further. I'm putting premium here, okay, of call option is equal to A minus present value of B. Simple. Now, can I say that this A is equal to the spot price of the share? Yes, because today I'm purchasing and hence A becomes the spot price of the share. Spot price minus present value of B. Okay. Then students, in one of the question we studied that there is a concept of hedge ratio. The concept of hedge ratio gives us a relationship that for how many, or let's say for one option, how many shares should I purchase or sell? Do you remember from our yesterday's discussion? So there we discussed that 0.5 means hedge ratio of 0.5 means 0.5 shares for one option. Correct? See, students, because we cannot say that the exact movement of share is equal to the exact movement of the price of the option. Correct? Because option pricing is something different and is dependent on other factors. So what we discussed yesterday is that for arriving that relationship, we have to calculate a hedge ratio. The hedge ratio will tell us that how many shares to be bought and sold so that one option can be traded. So for one option to be written, how many shares I have to purchase. That is given by the hedge ratio. Okay. So hedge ratio will give me how many shares to be purchased so as to write one call option, students. Okay. So can I till now in this equation, students, in this equation, I am taking 1:1, one share and one option. However, practically, we know that there is a concept of hedge ratio basis that only the number of shares and options can be linked. Okay, so what I will do now next, what I will do now next is I will, can I rewrite this formula as like this? Premium of call option is equal to spot price multiplied by hedge ratio minus present value of strike price. Understood, students, till now? Can I rewrite this? Why I'm introducing hedge ratio? Because it is not necessary one share will be purchased for writing one call option. Okay, students? Sorry. Now, all of you will be thinking that till here, till here, we have made an assumption that option will be exercised. What if option is not exercisable? Then, so we have not been able to answer that, correct? From step one itself, we are taking present value of strike price, assuming that the option will be exercised. But what if option is not exercised then? So for that, what we do is we generally take the of probability that the spot price on expiry will be higher than strike price. If there is a probability there, then then the option will be exercised and this step will be ensured. Okay. So I'm rewriting the above equation again in the below form. Premium of call option is equal to spot price multiplied by hedge ratio, students, minus, okay, let me do one thing. Sorry. Multiplied by hedge ratio minus present value of strike price multiplied by probability. Yes, Namrita, you're right. Probability that option will be exercised. So multiplied by probability that spot price on expiry is higher than strike price. Okay. If this probability happens, that the probability that spot price on expiry is higher than the strike price, then the option will be exercised. All of you can note it down, students. I will take a 1 minute. So, so this is it, students. This is the formula. We have derived the formula. Spot price multiplied by hedge ratio minus present value of strike price multiplied by the probability that the option will be exercised. In a way, probability that the spot price on expiry will be higher than the strike price. Okay. Now we will rewrite this in terms of those notations. Premium is equal to S into ND1 minus X e raised to the power minus RT Let me do one thing, otherwise you might get confused. Yes. Okay, XERT into ND2. So S multiplied by ND1 minus X e raised to the power minus RT ND2. So S here is the spot price. ND1 is the hedge ratio. This is the present value of strike price. X is the strike price and e raised to the power minus RT is the present value factor. So this is the present value of strike price. ND2 is the probability that spot price will be higher than strike price. Sir, here is option not exercised due to strike price not having achieved the set level. Yes. So if, let's say, the probability is 0, correct? So accordingly, there will not be any premium. Okay. So this is clear, students. So let's move to what is ND1 and ND2 now. Okay. I think rest all places, it would be clear, but ND1 and ND2, we will have to put it down. So I'm just putting the proper notation here. S is equal to spot price. X is equal to strike price. And D1 is equal to the normal distribution value for D1. And this is a cumulative normal distribution, okay? Normal distribution value for D2. This is again cumulative. Okay. Namrita is asking, why are we writing minus RT? Namrita, A is equal to P e raised to the power RT. You will remember I have discussed this in the continuous compounding, this formula. This is when the A is equal to the future value, P is the present value. So in present value, if you multiply e raised to the power RT, you achieve the future value. Now, if you have to achieve present value, then you will do like this, correct? P is equal to A divided by e raised to the power RT, or this also can be written as E minus RT. This is a property. This is a property. If the division is happening in the if the denominator is e raised to the power RT, if you have to bring it to the numerator, we can write e raised to the power minus RT. Okay, students? I hope this is clear. If you don't want to write e raised to the power RT, you can say x divided by e raised to the power RT. Simple. That is also fine. Okay. This is only applicable with respect to case 2. Yes, Shruti. I have just used the case 2 to explain you the Black-Scholes model for valuing a call option. Yes, I was explaining here ND1 and ND2. So ND1 is actually the normal distribution table value for D1. And this is a cumulative one. Okay. And ND2 is for D2. Now, what is D1 and D2? D1 is natural log of S by X plus R plus volatility square divided by 2 multiplied by T whole divided by volatility under root T. This is D1. D2 is actually D1 minus volatility under root T. So this is the formula for D1 and D2 respectively. Here R is equal to risk free rate of return. T is equal to time to expire. V is equal to volatility, which we also called as standard deviation of returns. S is equal to spot price and X is equal to exercise price. Yes, Shruti, I understand D2 and D1 are long, but they are like that only. However, not difficult to understand. Okay. So logically now we have to calculate D1, D2. Then we have to arrive at the normal distribution value of D1 and D2. Then using that, we will have to arrive at the value of the call option. No, Mansha, V means volatility. I mentioned V is volatility, which is the standard deviation of returns. It's not beta. There is no beta here. Now, I hope all of you would know what is called as a natural log. Natural log is actually represented by this IN. This, okay. Generally, what happens, E is actually called as the exponential function. Correct? And this is a fixed value. E is having a fixed value. So just to make you understand the interlinkage between E and this, natural log is actually IN. This is reverse of E. How? See, always remember this relationship, students. If E raised to the power A is equal to B, Okay. If e raised to the power a is equal to b, then natural log of b will be a. And here the base we will talk about e. So wherever the base of log is e, it is called as a natural log, and it is the reverse of this. So if we have to really find out, if let's say e raised to the power a is equal to b, you have this b value and you have to arrive at what is this a, then you will use natural log. Students, clear? So far, so good. Tell me, students, come on, this is still now clear? Perfect. Now let's think about a call option. And students, don't be scared. These values and these values will always be given in question. These are the easiest values to find out because these are always given in question. Only thing is sometimes it is not directly given. You have to use interpolation technique to arrive at these values. Now students, call option. We were discussing about call option. So D1 was actually what? It included natural log of S by X. So what if my spot price increases? If my spot price increase, this natural log of S by X will also increase. This will actually increase D1, correct? Sorry. This will increase D1 and this will also increase ND1, student. Sorry. The moment it increases ND1, this will also increase the premium. So you see the direct correlation. If the spot price increases, if the spot price increases, the premium will also increase. Sorry. Okay. Similarly, if volatility increases, if the volatility increases, which is the standard deviation, what will happen? Generally, if the volatility is higher, you will charge a higher premium because you will never know what is going to happen. Correct. So let's prove that if V increases, this will increase R plus V square divided by 2. It will increase. If this increases, D1 will increase. If D1 increases, ND1 will also increase. If this happens, then premium will also increase. Okay. Clear, students? Tanisha, pardon me, sir, but could you please tell why we are always taking risk-free return, which is a formula in the form of R against the market rate of return? Tanisha, because we have already taken volatility separately. See what we have done. We have taken the risk-free rate of return. Plus, we have taken the standard deviation of the returns here, squaring that. So this will give you the this will not give you the market return. This will give you the, so collectively, these two things will give you the security returns. That is what we need, correct? Okay. I hope this query is clear, Tanisha. Natural log not clear, Namrita. Okay. There is no need to understand natural log. Leave it. Natural log will be given in question. You just assume whatever this value is, that will be given in question, which is I n S by X. No need to go into detail and get yourself confused, students. Okay. I just told you because sometimes we get confused. Okay. But my purpose is not to make you more confused. Okay. However, What I told here is I can still explain it again. If e raised to the power a is equal to b, this is clear, correct? E raised to the power a is equal to b. This we have clearly seen in our previous questions. So if you have been given b and you have to arrive at a with a natural log, you can use natural log of b is equal to a. So if you do natural log of b, you will arrive at a. Again, there are tables for E and there are tables for natural log. But I am again requesting that the values will be given in questions. Namrata, I cannot explain how D1 formula is derived. I'm sorry. But, and see, this D1 formula, I have just given you a check whether if spot price increases, premium will increase. Answer is yes. If volatility increases, premium will increase. Answer is yes. But I cannot explain how this formula is derived. I'm sorry. Okay. That is not possible because this would have been an outcome of some of the study that BSM model would have been undertaken at. Okay. Shruti. Sir, possibility that spot price is higher than strike price and assumption. I mean strike price. Yes, Shruti, that is what the assumption is. And that is why we are multiplying it with this probability, which is given by ND2. Okay. Perfect. Let's move ahead. Now, students, this uses a principle of normal distribution. I hope all of you are aware about it, but again, I am touching back. So normal distribution, students, what does this mean? Normal distribution is based on some series of data. Sir, what's there after second plus sign in numerator? Which numerator you're talking about? I hope this. Suraj. Second plus sign, there is no second plus sign. This is T here, students. Okay. Now, students, hear me out. Okay, Suraj, Tanisha, yes. Now, normal distribution, students. So normal distribution, let's take an example of, let's say, X Limited. We have taken the series of data here. What is the series of data? Let's say it's past 10 years returns on a daily basis. Past 10-year returns. Okay, that you have taken. Basis that, can you arrive at mean and standard deviation? Yes, you can do. You can arrive at the mean and standard deviation. Now, using this mean and standard deviation as an input, you can put into the normal distribution model and arrive at the output as probability. So ND2 is the probability, right? So normal distribution is giving you output as a probability. Probability of what? Probability that the price will be there. What price? Strike price. Correct? That's what we need. That the strike price will be an outcome as a probability that we will use. I hope this is clear, students. So normal distribution also, students, is given as a part of the question. Let's do one thing. Let's take 10 minutes break And after we come back, we will again go through the Black-Scholes model through a question. Then it will be crystal clear to all of you students. Okay. Let's again reconvene at 8:30. let's get back to the Black-Scholes model. Thank you, Shruti. So, so students, till now, what we have discussed is that Black-Scholes model will give us the value of a call option, and that value of call option is dependent on a lot of factors, right? So all those factors have been taken into the consideration, students. So as a next step, let's go to the question, I think. Then we will be better placed to understand it ahead. Just a second, students. I might have to close this. Just give me a moment. Yes. So this is the question. Question number 13, students. Okay. So question number 13 says, this is again from the same assignment, the yesterday's assignment that was uploaded. From the following data for certain stock, find the value of a call option. It is saying price of a stock now. Okay. Exercise price is also given, spot price and exercise price, standard deviation of continuously compounded annual return, that is also given, zero point 0.4. Maturity period 6 months is also given. Annual interest rate of 12% is also given. Now they have also given us the number of standard deviation from mean. Okay. And the areas according to it. They have given us the E and natural log. All this information is given. There is one more thing, students, that I would like to discuss before this question so that at least those two parts is clear. Okay. See, one is that if you see generally this normal distribution is actually denoted by this bell curve. Okay. This is a simple bell curve. So on the middle is always the uh, mean, and let's say going upward and downward, I can say that it will be something plus or minus in the mean. For example, I had taken an example of past 10 years, right? For that, we have calculated the returns and standard deviation. Let's say the returns average comes out to 10% and standard deviation comes as 3. Okay. So in that case, this will become 3. Okay. And what if I keep on adding the standard deviation, let's say u plus 2 times of standard deviation, then u plus 3 times of standard deviation. Okay, so I will reach here 13, then 16, 10 plus 6 is 16, 10 plus 9 will be 19. Okay, and similarly here will be u minus standard deviation, which is 7. Then again u minus 2 times of standard deviation, which will be 4. Then it will be 1, like that. Okay, so it is plotted here. Correct. As I told you that in standard deviation, we input thus mean as well as, sorry, in normal distribution, we input mean as well as standard deviation to arrive at the probability. Now, area under this curve gives us probability. Okay, now let's say we have to find out the probability of 13. Okay, so 13 is still here. So whatever is the area under curve till 13 gives us the probability. Okay, for calculating this probability, we need to calculate the Z score. Okay, students, we have to calculate the Z score. Yes. Now, Let's take an example of 18. See, 13 will be easier. Let me take an example of 18 here. Okay. 18. Okay. So what is the probability that the next outcome will be 18? So we are trying to answer that, correct? So for that, we have to calculate a z-score. Z-score is actually given by 18 minus u divided by standard deviation. 18 minus mean divided by standard deviation. So that the probability that price is actually 18 is actually given by, sorry, or here we are talking about returns, right? So probability that return is 18 will be given by 18 minus 10, which is mean, divided by the standard deviation of 3, which is 8 divided by 3, which is actually 2.66. So the Z score comes as 2.66. So students, we have to remember this formula, okay? So this is minus mean divided by standard deviation. This is from the observation. Let's say observation is A. Okay, whatever we are having, for that we will do this operations. Now this Z score, we will actually look into the standard normal distribution table. So this you can actually find it out on internet and you can download it. And in, again, I'm saying in examination, it will be given to you very properly. So we have to calculate a Z score of 2.66, right? If you see, sorry, 2.66 is the Z score, right? So 2.66 in this table is this, correct? 2.6, and this is the number, right? 0.99609. So the probability that return is 18 will be 99.609 percentage. What is not there in study material, Shruti, about the normal distribution you are saying? See, normal distribution, I'm just explaining you because sometimes in the question, they will give you the terminology which is easy to understand if you understand this. Okay. And I will relate it to in this question itself. Now, one more thing, we have to always consider the cumulative probability. Okay. So if you see, there are two things to understand. See, this says represent the area to the left of the Z score. Okay. Table value represents area to the left of the Z score. So ideally, students, the cumulative probability. Okay, let me bring in here. Let's say we are calculating any probability till here. Okay. So let's say this is 18. So we have to consider area from the left till 18. This is called as cumulative area. And this is called as left to Z score, right? Shruti, we need to check. I am not seen. We need to check. Okay. So cumulative area from left to Z score will give us this. Sometimes the question says that it is a one tail number. One tail number means if let's say the area, if let's say the observation is 18, one tail means from here. Okay. So in that case, what we need to do for arriving from one tail to cumulative, we have to do, let's say this one tail number is given as, let me put it like this, 0.70 and 0.30. So what is the total probability? Always is 1, right? So if one tail is 0.30, the cumulative from left to 18 will be 0.70. So Namrata, we take cumulative because we have to arrive at the total probability. See, if you really ask me, what is the probability to achieve at 18? I will always take a cumulative probability from left to right. That is my total probability to reach at 18. Okay. So this will become 1 minus 0.30 is equal to 0.70. Okay, students. I hope this is clear. Sometimes. So, okay, now one tail is clear. Sometimes we have been given two tail. Okay, so what they will do, they will just take the one tail and multiply it with 2. Okay, so for calculating again cumulative, we have to divide by 2 and then 1 minus. So we will again cover in the question. Okay, so Z score brings out. Why do we calculate Z score? Okay, I will answer that. See, the reason of calculating Z score is to bring your mean as 1, sorry, your mean as 0 and standard deviation as 1. Because the mean and standard deviation of a normal distribution is this. So what you are doing, you are minus mean divided by standard deviation, right? So that means you are taking your mean to 0 and standard deviation to 1 to arrive at the Z score. I hope I am able to answer your question, Namrata. Okay. There is one more property of standard normal distribution table. So 99.7 percentage value is resting between u minus 3 standard deviation and u plus 3 standard deviation. So mean plus 3 times of standard deviation and mean minus 3 times of standard deviation within that range. 99.7 percentage observations will be there. Okay. Now let us come back to this question, students. Okay. So students, we have to arrive at the value of call option using Black-Scholes model. Okay. First of all, let us write the equation, students. Value of call. Now, I request everyone to focus here. The things will be clear once you go through one question. It is very easy and very simple, students. Again, I'm telling you, right? S. Shruti, that is a property. Shruti is asking why 99.7% values exist. That is a property of standard normal distribution table. Okay. So that is a standard table, right? So there is a property of it. Now let's leave all those things behind. See, some of things are relevant and some of them are not, but please now focus on this question. So this will make a lot of clarity in all of you. Okay. So let's first put the formula here. Okay, students, this is clear. Value of call will be equal to S, which is spot price multiplied by ND1 minus X e raised to the power minus RT, which is the present value of strike price multiplied by ND2. Here D1 is equal to natural log of S by X plus risk-free rate of return volatility square divided by 2 multiplied by the time period to expire whole divided by volatility underscore T. Okay. So first of all, students, natural log of S by X is equal to natural log of what is S? Spot price 80. What is exercise price? 75 students. Okay. This is equal to natural log of 1.0667. Can we see what is given in the question? Natural log of 1.0667 is given. It makes your life very easy, students. Is it okay? Tell me, is your understanding of natural log needed in this? No, right? You just need natural log of 1.0667, and that is what is given to you in the question. You just make use of it. Simple. 0.0646. Okay. Till now, clear? Tanisha, tell me what is not clear. You're saying no. Is there something? Okay, no, you mean there is no problem in the life. Okay, perfect. So, natural log S by X is calculated. Now, let's come back to D1 back. 0.0646 plus R 0.12. Correct? R is given 0.12 plus 0.40 square divided by 2 whole multiplied by T, which is 6 by 12. Now, students, please note that this is always annual percentage that we have to take, because you are multiplying with time later on. Okay, you are already multiplying with the time later on, so you have to take annual percentage of return. Then this whole okay, Tanisha, perfect. Divided by 0.40 under root 6 by 12. Let's calculate D1. 0.0646 plus 0.12 plus 0.08. Let's keep on calculating this, right? Multiplied by 0.5 divided by 0.40 into, if I do that, then it becomes 0.2828. So D1 becomes 0.1646 divided by 0.2828, which is equal to 0.5820, students. D1 is equal to 0.5820. Okay, clear? Then D2. D1 minus volatility under root T. So D2 is equal to D1, which is 0.5820 minus. So student, this is the denominator of D1. Okay. So we can just simply use denominator of D1, which is 0.2828. $0.2992. So D2 is equal to 0.2992. Clear? D2 is also clear. Yes, Mansha, you're right. Tanisha, you're right. Mansha, just check. I think there is a bit rounding of difference. Okay. Now we have calculated D1 and D2, students. Simple. We have to calculate ND1 and ND2 now. What is ND1? Let's replace D1 with a number 0.5820. And ND2 is how much? 0.2992. Correct? Suraj, I really don't know how much marks this would come. But I can tell you if this comes, then all of you will be very lucky because there is nothing to be done. You just need to do the simple putting of the formulas and take values from quotient and arriving at the numbers. That's all. Okay. Now, let's come back here, students. If you see, it is mentioned here number of standard deviation from mean Z. See, they've clarified Z score. What is the Z score I've told you? A minus mean divided by standard deviation. So number of standard deviation from mean is the Z score. So if 0.25 is the Z score, then area to the left or right, which is one tail, is given as 0.4013. Do we need one tail? No, we need cumulative. So from one tail can we arrive at cumulative? Yes, we can do that. So let's come back, students. Number of standard deviation from mean 0.25, 0.30, 0.55, 0.60. Okay. One tail. See, this is Z score. Okay. This is Z score. And one more thing, students, this D1 and D2 is already a number that we have calculated as a Z score. So we have to just simply take this for the normal distribution. So there is no need in the quotient to calculate a separate Z score. Okay. One tail is 0.4013. Here it is 0.3821 again given in the question. 0.2912 and lastly 0.2743. Okay. Now for one tail, we have to arrive at the cumulative. So this is area from the left to Z score. Correct? We can do that. So which is 1 minus 0.4013, 1 minus 0.3821, 1 minus 0.2912, 1 minus 0.2743. So this becomes 0.5987. This becomes 0.6179 and this becomes 0.7088 and this becomes 0.7257. Simple. Okay. Now for ND1, which is 0.5820, it falls in between these two values. So we have to use interpolation technique, students. We have to use interpolation technique. Sorry. Sorry. So using interpolation technique, can we arrive at the value of 5820? Sorry. Yes, we can arrive at. So 0.55 is given as 0.7088, 0.60 as 0.7257, Sorry. See, if you want to reconcile this, right, from the normal distribution table, 0.55. Sorry. So this becomes 0.70884, right? See again the same value, right? 0.7088. Okay, I'm just trying to tell you that the numbers will be given in question itself. Sorry. Using interpolation technique. So yes, using interpolation technique, students, we can arrive at 0.5820 is equal to 7088, which is the 0.55 equivalence value. Then the difference between these two, 7257 minus 0.7088 whole divided by 0.60 minus 0.55. Okay, multiplied by, so this multiplied by, I'm putting it here, 0.5820 minus 0.55. So this will give us the value of 0.5820. This is simple interpolation technique, students. So n 0.5820 will be equal to 0.7197. Again, I can also show you the calculation of normal distribution table for the other value so that it is clear. So the second one actually is 0.2992, which will fall somewhere in between 0.25 and 0.30, right? So in interpolation technique, what we do, we start with the lower values number, add the difference of these two with the difference of the Z score. Then what is the difference between the required to lower value? So see here, students, again. So first we will take the 0.25's value, which is 0.5987. 5987 plus, what is the distribution value for 0.30? 0.6179 minus 0.5987 whole divided by 0.30 minus 0.25. Correct? So this is actually the interval value multiplied by where we have to reach. We have to reach 0.2992 minus 0.25. Okay, students. So if you solve this, then this value becomes 0.2992, 0.6176. You can note it down, students. Then we have to just place down the values now, which is value of call option. Spot price is 80. 0.7197 is the hedge ratio, students. For every one call option, 0.7197 equity share needs to be purchased. Okay. Minus 75 into e raised to the power minus 0.12 is the rate and 0.5 is the time period, students, into 0.6176. So the value of call option becomes 57.57 minus 75 divided by e raised to the power 0.12 into 0.5. This also we can do, right? Because I have explained you, if it is in denominator, we have to take in numerator, the power becomes in minus. Okay. Then finally, the value of call option becomes 57.57 minus 75. So this value is also given in the question. What is the value? E raised to the power 0.12 into 0.5 is 1.062. 1.062, students, into 0.6176. Okay. So the value of call option is 57.57 minus 43.62 is equal to 13.95. Tanisha is asking, but could you please once explain the value of, since I got an answer of 0.46448 upon solving the equation. Okay, Tanisha, let me again put down the equation. See, we have to calculate normal distribution value of 0.5820, right? We have it for 0.55 at 0.7088 and 0.60 as 0.7257. Okay, this is what we have. Now, if we apply the formula, 0.5820 is equal to, first of all, the basic value 0.7088 plus the difference between these two, 0.7257 minus 0.7088 whole divided by 0.60 minus 0.55. So which is the difference between these two values, right? So for every 0.05, the numerator, what we have mentioned, will move multiplied by, what is our target? Our target is to reach 0.5820 minus where we started with this value, which is 0.55. So if you solve this, then it is coming as 0.7197. And Tanisha, one more thing, you are saying that you are getting 0.46448. Just check, Tanisha, it cannot be the case because the value has to lie in between these two values, 0.70 and 0.72. It cannot be 0.46. Okay, Tanisha, just check again once. But the clear equation I mentioned here, in case there was some doubt on the equation part. Okay. So the Black-Scholes model is clear, students. Tell me if you have any other question left in the BSM. Is there something else left in the Black-Scholes model, students, or shall I move ahead with the next discussion? So, got it? Okay, Tanisha, thank you. So let's discuss about the put option. So till now we have discussed about the call option valuation, correct? Now let's discuss about the put option valuation under Black-Scholes model. All clear, perfect. Students, are all of you ready? We'll move ahead. Tell me, frankly, tell me, BSM is not that big or that difficult that we understand. Although I understand there is one complex formula of D1. That's all. But that also can be remembered easily, right? And the values will definitely will be given in the question as is for all the things. Okay. So for using the put option valuation technique, I am making use of case 4 that we discussed yesterday. What was our case 4? Sell put option. Yes, Shruti Namrata Mancha, perfect. Thank you. Very nice. So for put option, I'm making use of case 4 where I said that we will sell a put option. Now, if I'm selling a put option, that means I'm selling a right to sell. Sell, right to sell. If I'm selling a right to sell and tomorrow that option gets exercised, I have to purchase the share. I have to purchase the share, right? Now, if I have to purchase the share at that point of time, that means I need to sell the share today in the spot market. Correct? That is how it will work. That's what I also insisted that day. That let's do one thing. Borrow one asset. One asset means one asset of equity, right? Let's do a short sale of that equity in the market. This asset is actually equity. Okay, short sale of that equity. Whatever is the present value of strike price that I will invest, because if tomorrow the right to sell is exercised by the option holder, my cash outflow will be there. Cash outflow to the extent of strike price will be there, correct? Because I will have to, for him to sell and I have to purchase. Since I have to purchase, I have to pay him the strike price equivalent money. So that cash outflow will happen. For securing that cash outflow, I will invest the present value of strike price today. Correct? Then on expiry, I will redeem the present value of strike price on maturity. Correct? After doing that, the option will get exercised and hence I will be able to purchase one share, which is again equity, and I will pass it on to the person from whom I have borrowed it. So the chain is clear. My strategy is clear. So this is exactly the case number 4 that we discussed, right? So this is a bit detailed version. That day we just discussed only 2-3 steps. So this is case number 4. Okay. Now, this is step 1 to sell a put option. And the step two will be to borrow one equity and short sale of equity in the market. So what I will do, I will sell equity in spot market. So this is my cash outflow. I'm putting this event as A. This I'm putting as event as B, and this is going to be my cash inflow of spot price today, right? So don't you think the difference between my outflow, my inflow, I will be charging as the premium for put option. Okay. So if you don't remember, if you're not required to remember all this, okay, this is just a building the discussion. Okay. This is, I just used to build up the discussion. The only thing that we need to remember is this, that the value of put will be x divided by e raised to the power rt, or x into e raised to the power minus rt, whichever way you want to see, n minus d2 minus spot multiplied by n minus d1. So this is actually going to be your cash outflow, and this is going to be our cash inflow. Okay, perfect. So students, while discussing ND2, I said that what is ND2? ND2 is the probability that price will be higher than strike price. Correct? This is what we have discussed in ND2. Probability that price will be higher than strike price. For ND1, sorry, for N minus D2 means minus D2 will mean, can anyone guess, students, what will be N minus D2 come to? And since we are talking about put option, in put option, we have used N minus D2. Think. If ND2 is the probability that price will be higher than the strike price in case of a call option, N minus D2 is the probability. Think and answer simultaneously. I'm just putting it. Probability that price will be dash then strike price. So fill in the blanks. What is this dash? We are talking about put option. Yes, very good. Tanisha and Mansha, yes, you have made it. This is lower. Perfect. See, the things sometimes become self-explanatory. Here, for put option, we have to see that when will the put option will get exercised? When the spot price on expiry becomes lower than the strike price. Okay. Yes, Namrata and Shruti, very nice. So the cash outflow will be happening only when the spot price is lesser than the strike price. Then only right to sell will be exercised by the holder, and I have to pay him for purchasing that one share, the strike price equivalent value. Simple. Okay, so this is the formula, students. I hope this is clear. Again, we can calculate the value of put option using the same formula. I hope this is clear, students. Any questions in the valuation of put option? Please do let me know. Okay, let's move ahead, students. So I think by mistake, this 14 question has been repeated in the assignment. We have already covered this, students. We have covered this. I think this was question number um 7, 8, 9, 10, maybe 11th question was it? Yes. This is same as to question number 11th. Okay. So this was covered as question number 11. This got repeated. So we are not covering this. Okay. Now, students, see till now, students, what have we done in derivatives? Derivatives. See, we have understood about forwards. We have understood about futures. We have understood about options. Correct? For all these three, we have understood the concepts. Correct? We have understood the concepts. We have understood how these are useful in a hedging technique. Correct? We have understood how these are useful in hedging techniques. Some of the questions today we discussed. How Ram will hedge the reliance of the shares of Reliance Industries Limited by entering into a put option. Correct? Depending on the fact pattern, we are clear how to devise the hedging strategy. Hedging strategy is taking one position in one market and the other position in another market. Similarly, in forward and future, students, you would remember what all things we discussed. Third, we also discussed about the valuations. Correct? What are the different valuation methods? So forwards and futures. The valuation of forwards and futures is all about compounding. Correct? Taking into account dividend and other things. For options, we discussed following things. One is binomial model. Second, we also discussed about uh, the risk neutral method to calculate the probability, which is again linked to binomial model. Then we today discussed the Black-Scholes model, in which we discussed about both for valuing call option and value of put options. Okay. Till now, we have studied these things, students. Okay. Now, let us come to the put call parity theory. We are still in the options discussions, right? So we will discuss the put call parity theory, students. And one more thing, for this call option valuation, we have one more question on Black-Scholes model. Okay, that we will cover tomorrow morning. Okay, so that, same concept I will revise in the tomorrow morning also, so that it will be crystal clear. So as of now, let's discuss about the put call parity theory, because in that question, there is a use of this put call parity theory as well. So students, what is put call parity theory? I've built it through one example. Okay, I just want all of you to follow me in that example. Then it will also be crystal clear along with the logics. Okay. So just hear me out, students. I've taken a simple example where I'm saying, let's say the time is 1 year. We are talking about a call option and we are also talking about a put option. Okay. And in this, students, I am making use of case 1 and 3. Can we go back and check where I've mentioned those cases? Wait, let me bring on that cases thing that we discussed. Uh, just a second, students. For your clarity purposes, let me bring out that 4 cases that I've plotted somewhere. Let me just find it out. So it's question number 2, question number 3 we did today. Four, binomial model we were discussing yesterday. Yes, these are the cases. Now hear me out. Sorry. So the case 2 is used in valuation of call option under BSM. Valuation of call option under Black-Scholes model. Case 4, which is short put option, right to sell, invest present value of strike price today, correct? All these things I've discussed in value of put option under Black-Scholes model. Correct. Here also what we did, short call option, right to buy and purchase a share today. Purchase a share today equivalent to the hedge ratio, right? So that was called as, that was used in the valuation of call option under Black-Scholes model. Now this long call option and then invest present value of strike price today. This case along with the case 3, which is long put option and purchase shares today. This we will be using in put call parity theory, PCPT. Okay. Here also put call parity theory. Clear? Perfect. So let's move ahead. Yes, students. So put call parity theory. I said that let's take an example of a call option and a put option where I'm making use of case 1 and 3. And here R is actually, let's say 20% per annum. Time is 1 year. Strike price, let's assume to be 180. Spot price, let's take it as 150. Okay. The value of put option is, let's say, 10 rupees. The value of call option is, let's say, 15 rupees. This is premium I'm talking about. Okay. These facts are clear. So using this, What one, so basically I will take two different scenarios. Okay. In scenario one, I mean, these scenarios are nothing but those cases only, right? And this is scenario two. Okay. So scenario one, what happens? A person purchases a purchase put option at the rate of rupees 10, correct? Because the premium is 10. And if he purchases a put option, I'm purchasing a right to sell. If I'm purchasing a right to sell and on expiry, the option becomes exercisable, I have to sell that asset. For selling that asset, I have to purchase that asset today. So this is the spot price of purchasing that asset today. Okay. Purchase asset today. What is the current spot price? 150 students. 150. Correct. So the total cash outflow is minus 160. Okay. So the total cash outflow is minus 160. I will have to spend 160 today to build this portfolio. Portfolio of what? One purchase of put option and one purchase of asset today. Now, some of you should be thinking that I have purchased a put option, I have purchased a share also. So I have not taken an opposite position. No, students, that's not the case. You have purchased a put option. You have purchased a right to sell. So that means on the underlying, you are going short. Okay. That's what the point is. So in a way, you have, in terms of your risk profile, you are taking a short position in the options market and you're taking a long position in the spot market. This is another way to put it. Okay. So in a way, there are two different positions. One is the long position of equity in spot market, and by purchasing put option, you have taken a short position in the options market. Scenario 2, students. Scenario 2, we have purchased call option. Okay, we have purchased a call option, students. Now the call option will be purchased at what rate? 15 rupees, right? Current premium appearing in the market is 15 rupees. Students, tell me if all of you are there with me till now, then I will move ahead, okay? Please mention if there is any other doubt till now, please let me know. For purchasing a call option, if I purchase a right to buy, and tomorrow, let's say not tomorrow, but 1 year from today, if I have to exercise such option, what I will have to do, I will have to pay the amount equal to the strike price. So that means today itself, I will have to invest the present value of strike price so that after 1 year, I can make use of it. Correct? That is what was in case number 1 also. I will invest the present value of strike price today. Invest present value of strike price. What is the strike price? 180. How can we calculate the present value? By just taking a 1 year before value, which is 1 plus 20%. So 180 divided by 1.20 is actually 150 rupees. So the total value becomes 165. Here also the cash outflow becomes 165. So for purchasing in call option, I will pay a premium. For purchasing a call option, I will pay a premium of 15 rupees. For getting this call option exercised, I will have to invest 150 rupees today So the cash outflow is 165. Okay, perfect, Tanisha. Yes. Namrita is asking why we calculate put parity theory. We have to calculate put call parity theory because this scenario one and scenario two that I've placed in front of you, it is going to give us a very good insight. Okay. And it will tell us that the market will always be in that parity. Okay. So we have two scenarios. So the first scenario is for investor one, who is a put option holder. This is for investor two, which is a call option holder. Okay. Investor one is a put option holder. Investor two is a call option holder. Now let's take a subsequent cash flow impact. Let us see if on settlement after 1 year, that is after 1 year, what will happen? Correct. After 1 year, what will happen? We will assume two, three different set of prices and accordingly calculate. Okay. So subsequent cash flow impact after 1 year. Let's take first of all an example that the price comes as, let's say, 200. We will take multiple examples and then we will prove, right? On expiry, the price comes as 200 from the current price of 150. Okay. It can happen. Now, what will happen to the cash flows of the first portfolio person? This is okay. Investor one, I'm putting again. Investor one, I'm putting. Okay. Now, investor one has purchased a put option. Students, the strike price of put option is 180. The price appearing in the market is 200. Tell me, what is the benefit to the put option holder? Tell me, what is the benefit to the put option holder? Yes, Tanisha. It's the part of the put call parity theory only. Till now, we have not concluded what is really coming out of the put call parity theory. So within put call parity theory, first we have taken on the initial cash flows. Okay. Now we are talking about the subsequent cash flows. Yes, tell me students, the strike price is 180, exercise price is 200. So is it in the money or out of the money? Yes, Namrata is saying out of the money. Tanisha is saying gain of 40. No, Tanisha, it will not be a gain of 40. Namrata is saying no benefit. Yes. Tanisha, please check once. Let us check how you're saying gain of 40. See, we are talking about the option as put option. Put option strike price is 180. The market price has gone up to 200, has gone up to 200. So that means it is out of the money. Now, since it is out of the money, investor one, what was his initial portfolio? He had purchased a put option and he had purchased a share also. Sorry. So Sorry. So put option, subsequent cash flow will be nil. Correct? Because it is out of the money. However, shares purchased will be sold now. Shares will be sold at the rate of 200. Okay, Tanisha. Perfect. You got your issue sorted. Okay, so shares will be sold at the rate 200. In this case, the sale proceeds will be positive 200. So the net cash inflow after 1 year will be 200 rupees for investor one. Okay, we have proved it. For whatever holdings that investor one had at a price of 200, the net cash inflow after 1 year will be 200. Now let's take a investor two's case. Now investor two had purchased a call option. If I've purchased a call option, which strike price is 180, market price in this case that we are assuming is 200. Okay, strike price is 180, market price is 200. Then there will be, so this is out of the money or this is in the money, students? Tell me, first of all, this is the first question. So this call option where the market price is 200, is it out of the money or it is in the money? If it is in the money, then what is the payoff? Tell me, students, come on. It is in the money or out the money? We're talking about the call option. Suraj is saying out of 200, STT will not be deducted. We are not discussing about securities transaction tax, Suraj. Okay. There will be implications of STT, but we are not discussing about that. That's a very practical thing. Namrata, Tanisha, Mansha, Shruti. Yes. Four of you are correct. I think only four of you are answering. No one is answering the questions. So it is in the money and the payout will be 20. Very good. So can I say that for investor two, the call option, which is in the money, will derive me a benefit of 20 rupees. Correct? It will derive me a benefit of 20 rupees. However, I have invested the present value of strike price. Correct? For that, yes, 20 rupees will be the payoff. Very good. Suraj, Tanisha, both of you are correct. 20 rupees will be payoff. Now, I have invested the present value of strike price. That also I will get as a redemption, right? So I will get on maturity how much amount? 150 into 1 plus 20 percentage as return. So this is how much? 180. So in totality, I will get a 200 rupees of cash flow. Net cash inflow after 1 year will be this much. Till now, students, we have not been able to conclude what is put call parity. Okay, we will conclude that. Till now, it is clear. Viraj, 20 in the money. Yes, Viraj, thank you. Tanisha, sir, why not 20, 165 get on maturity? Please tell. No, 165 will not get on maturity. See, we have invested how much? We have invested 150 rupees. Okay, let's go to the portfolio of investor 2. This is investor 2, right? What did this investor 2 did? He purchased one call option, which is fine. Then he invested 150 rupees at the rate of 20% for 1 year to arrive at the strike price of 180. Correct? So hence on maturity, this person will get this much. Now, this is students. We have taken if the price comes as 200. Now let us take one more scenario where the price comes to, let's say, 100. Okay, let's take one more scenario. But even if you take price as 200, have you noticed something, students? I have projected something in front of you. Tell me, what is your observation between investor 1 and investor 2 while we talk about the price as 200? Can anyone tell me what do you observe? There is one common thing that you can observe in investor 1 and investor 2. Tell me what is that common thing? Yes, very nice. Namrata and Tanisha are correct. Good. So both of them have got the same amount on maturity with whatever portfolios they have created. The net cash inflow on maturity remains same. If that is the case, then we have to test this possibility. Yes, Namrita. Net cash inflow after 1 year is same. Yes. So if that is the case, we have to test this possibility in some other scenario also. Let's take one more scenario to prove this. What is that another scenario? If price comes down to 100. Okay, let's take this example also. Now, if price is coming down to 100, let's take investor 1 first. Investor 1, put option, strike price 180, market price 100. Tell me, students, whether it is out or in, and if it is out or in, what is the payoff? Now, come on, students, tell me. Answer, students. 180 is the strike price, 100 is the market price. Whether it is in the money or out the money, if it is in the money, what is the payoff? So if 180 is the strike price, 100 is the market price, it is definitely in the money, students. And the payoff is 80 rupees. 180 minus 100. Yes, students. Thank you, Suraj, Tanisha, Mansha, Namrata. All of you are correct. So for investor 1, let's come to the put option. It is in the money and this person will get 80 rupees. Correct? Now, The second thing that investor one had done was shares will be sold, right? He was also possessing the shares. No worries, Tanisha. He was also possessing the shares. So shares to be sold, 100 rupees, right? Will be sale proceeds 100. Total, he will get 180. Net cash inflow after 1 year is equal to 180. Correct? Now, if net cash inflow after 1 year is 180 for investor one, now let's go to investor two, students. Okay. For investor two also, we will analyze if the price goes to 100. Now, for investor two, he was holding call option. Strike price of that call option is 180 and market price is actually 100. Now tell me, students, whether it is out of the money or whether it is in the money. And if it is in the money, then what is the payoff? Tell me, students. For call option where the strike price was 180, the market price is running at 100. It is out of the money or it is in the money? Deeply out. Yes, Mansha and Namrata. Perfect. So this is out with a zero payoff. Okay. So investor two will have call option which is out of the money. Hence, cash flow on this will be zero. Correct? Then, since investor 2 also had what? Investor 2 also had invested the present value of strike price, that is 150. So that maturity also he will get on maturity. I mean, realize on maturity. 150 into 1.20, which is again 180. So the total is 180. Net cash inflow after 1 year for investor 2 will also be 180. So even in this case, the value remains same, although it is different from our first case where we took the prices as 200. Now in this case, even at the price of 100, although the values are different, but it is same between investor 1 and investor 2. So whatever, can we conclude then, whatever prices occur in market, realization of investor 1 is always equal to realization of investor 2. If this is the case, then their initial investments should also be same. Correct. If this is the case, then their initial investment should also be the same. Then only it will make sense, because otherwise what will happen? Otherwise, I will prefer investor 1 because investor 1 is able to invest at 160 and arrive at the same value which investor 2 is investing at 165 and arriving at. Correct. So what market forces will do? Market forces will make their initial value also same. So investor 1 initial value will also become equal to the investor two's initial value. So what will happen in such a case, students? The value of call and put will change. So value of call we have assumed 10. Here we have value of put we have assumed 10 and value of call we have assumed 15. So these 10 and 15 will move up or down and make these two portfolios equal. So this is what the final final concept is, right? So value of put plus spot price. This is the investors once cash flows, right? Is would be equal to value of call plus present value of strike price. So the put call parity theory is actually this. Put call parity theory says that if you take value of put and add the spot price in that, it will always be equal to the value of call plus the present value of strike price. This is actually for investor one. In our example, I'm just saying, and this is the portfolio for investor two. Correct. And the logic is very simple. If their realization value at the end of the tenure is going to be the same, then there is no reason why there should be the initial value should change. So the initial values would also be similar for put call parity theory. Okay, students. Are there any questions till now, students? Because till now we have covered the DSM and put call parity theory. Yes, Tanisha, it is at the par value of these investments, but with these numbers also, right? So value of put. So we cannot say always that the value of put will be equal to value of call. So we in value of put, we have to add spot price. In value of call, we have to add the present value of strike price to arrive at the single valuated numbers. Okay, students. So there is, I think, one last question left from our assignment, which is question number 15, which is, I think, a very big question. I don't think so we will be able to cover up today. So we will start with this question in the next session, along with some of the other concepts that are remaining from the derivative, students. Till now, if there is some other question, students, please do let us know. Okay. I request C. Ashish sir, who is there with us to help us with the concluding remarks.
Thank you, Devas. Am I audible?
Yes, sir. You're audible, sir.
Okay. Okay, your session was very good. And only one or a couple of queries have I have watched that there was some query regarding how many marks student has
Yes,
come
sir.
in the examination. There was one
Yes,
question.
yes, sir. Yes, sir.
See, student, normally, so far as the question marking of the question is concerned, there is no fixed pattern. Of course, this question can't be I think it was asking in the context of Black School's
That's
model.
false model. Yes, sir. Yes, sir.
Yeah. Normally, this type of a question does not carry the 2 or 3 or 4 marks. Of course, they will carry minimum 8 marks. However, what happens now? Say a full question contains 3 subparts, 2 to 3 subparts. In this case, what happens? It may be possible that if the other part may be simple, they may be given 8 marks, but time consuming is very less. Whereas the same question, that is Black School's model, may be consuming more time, but they may also be given they may be allotted 8 marks only. So in that case, what happens? The balance will be there. The timing scheme is seen from the angle that it should be uh, it should be like that. The time allotted for a one full question, not subparts. Like so, there will be no problem for this. I think there was one issue regarding table. One student has asked a student they will not be given the table. I think it was like that. No? There was sir. It was like
Yes,
that.
sir. Yes, sir. Yes, sir. That was right. Yes.
See, student, the table will be provided you, or the values, respective values will be provided you in the examination. In case if it is not provided, don't worry, leave the question there. We will take care of the same. You not to worry about the same. Okay, institute will take care of the same. Okay, student. So with this, we come to the end of this session. As a practice, just Divas sir, please
Yes,
write down our phone number.
yes, sir. 0120.
20.
Sorry, just a
No problem, no problem.
0120
3045
3045
956.
956.
Okay, student. So you can contact as this number on uh, your, or you can send your queries through mobile app. And thanks a lot for your patience listening. And Divas sir, thanks for your sparing your precious time and enlightening the student on this topic. Thanks a lot. Have
Thanks
a
a lot.
nice day.
Thanks a lot.
Okay.
Thank you, sir. Thank you.
Okay.